trying to time the market, yes, you can time the market. However, timing the market has rarely been a winning strategy. To consistently outperform the market, investors have to invest for the long term. Investors who try timing the market often miss the biggest market rallies. While trading might be successful part of the time, a large part of investors underperform indexes due to frequent mistakes, over trading, and emotional decisions. Compounding benefits are greatest when staying invested for the long term. It usually comes down to a few unpredictable days. Dollar cost averaging is widely recommended for those who lack the time to study correctly or the expertise. Basically, you want to be able to follow the markets every week if you can. But if you don't have the time, investing for the long term, buying companies with moats is a great idea. You can time the market, but the data indicates being invested today is usually a better strategy overall. You know, you can check out these books right here by Benjamin Graham, The Intelligent Investor. Talks about this in one of its chapters. It's basically shows 3 different scenarios where one investor dollar cost averaged all the way through 20-year period, while 2 other investors tried timing the market, and the investor who dollar cost averaged actually come out ahead compared to the investor who just tried to time it and timed it incorrect. So, you know, consistency pays off. Another great book to read is Howard Marks, Mastering the Market Cycle. While most investment professionals take the standard out that you can't time the market, in Mastering the Market Cycle, Howard Marks, a living investment legend, takes the contrarian point of view that not only can you time the market, but it's imperative to do so. So basically, this book right here will give you better advice if you want to time the market. Generally, I like to invest in October. You know, September to October is really the best time. You want to wait till Wall Street takes profits in a lot of their companies. We usually see a big pullback like today. You know, if you look at the market, we've got Carvana down 7%. You've got Coinbase down 7%. You know, these days right here are perfect times to invest. So it's another great book to read if you're wanting to understand the market overall. Is you really want to focus on the big picture and not get caught up in market corrections. And you know, you basically, if you're just always holding a bunch of cash waiting to see if you can buy, you know, this month or next month, you're missing out on some very nice returns. You know, as you become more advanced, you can go from the dollar cost average strategy to investing during the corrections. You know, today would be an excellent opportunity. So it's important to study market trends. So if you haven't bought these 2 books, you know, The Intelligent Investor by Benjamin Graham or the Mastering the Market Cycle by Howard Marks, you can get those at my website at joshslozinvestments.com. They're both highly recommended. But I mean, the market overall, you know, it's there's a lot of different things that go into it. We have a monthly CPI report, inflation, you know, all these reports that the government has, you know, decides if our market's going to, you know, go higher or lower. You know, it's like right now we're waiting on rate cuts, and when we have rate cuts at the end of this month, you know, it'll be roughly probably 25 basis points. It'll probably be the catalyst the market needs to make a nice surge forward. And if you're invested in growth stocks, especially, you're looking to make 3 to 7%. You know, if you take a quick look at Duolingo, ticker symbol DUOL, it actually was up 7% during the last rate cuts. So that's very important that you pay attention to what type of stocks you're into. You know, you're going to see a lot less volatility if you like dividend stocks. A great book to learn about inflation is probably Stabilizing an Unstable Economy by Hyman P. Minsky. If you just read these 3 books right here, you will see that you'll basically get a broad understanding of what causes the markets to go higher and what to do during market corrections. You know, you always want to buy on the market dips, and you can take advantage of when the market roars back. You know, we've got 3 months probably to go of at least some record profits, and anytime there's a pullback, that's an excellent time to invest. I mean, you can just take a quick look at a stock's fundamentals, and you can see that if a company is making money, and you can also see the company's current PE, and the current PE is price to earnings with a forward PE of what their future earnings are. And when the forward PE is lower than the current PE, you know, obviously the company is going to have a increase in stock price at some point because the company is doing better than it currently is. So, you know, anytime these stocks dip and their forward PE is lower than their current PE, you definitely want to take advantage of these opportunities to buy stocks like Palantir Technology, for example, is a great example. You know, its PE's around, you know, I believe there's a 100 point difference between its current PE and its forward PE. So it still shows room for growth. I mean, if you take a look at other companies that's done really well, Duolingo, like I said, Robinhood's had an amazing run this year. And if you look back over the last 4 or 5 years, Nvidia's had an amazing run. Tech companies especially do well during market corrections. So if you're trying to time the market, you can tell if something's overbought or not. There's a MACD line. If you look on Webull, and anytime the stock happens to fall below the MACD line, you know, you can roughly see where that stock should be trading at. You know, it's, you know, first thing I recommend is check to make sure that the best way to evaluate a stock is by using the Intelligent Investor. You know, you want to make sure that its fundamentals are all in line. Then after that, then you can use technical analysis using the MACD line. You're set to make a whole lot of money. You know, I would stick with companies that just have moats. You know, you really don't need to switch up. Just stay with the best company in that sector, and you stand to make considerable gains. You always want to protect the downside. Appreciate everyone watching this video. Please hit the like and subscribe, and I will be making another video this week. If you have any comments or questions, leave them in the comments below, and I'll be more than happy to answer. Have a great week.